After a good start to the year, we ask ourselves, have equities lost their momentum? Hello and welcome back to our channel. My name is Daniela Hathorn from Capital.com. In today's video, we are going to be looking at the equity market, specifically US equity indices. So we'll be looking at the likes of the S&P, the Nasdaq and the Dow. But before we get into it, please like this video, comment, subscribe and turn on your notifications. We had a relatively good start to the year across the board, really. Risk on sentiment really pushing higher on the back of that reopening trade in China. That positive news being priced into the markets. We did see outperformance in US equity indices, of European equity indices over US indices, but nonetheless, positive momentum across the board. We saw that performance as well in commodities. We saw copper edging higher, gold, silver following the likes as well. In the FX market as well, we saw that positivity allowing those risk on currencies, those high beta currencies to outperform the likes of the US dollar. So that is generally the momentum we've had for the first 2 weeks of the year. Now, it seems like we have started to hit a little bit of a wall. In fact, we've seen a move lower in risk sentiment across the board. Again, we've got gold down, silver down, copper as well. FX market stagnating a little bit as well, finding that resistance. So it seems like we've got a move lower across the board on risk sentiment, but we've really seen it on the US equity market, which is what we're going to be focused on today. Now, the main thing to note is that we have had a host of economic data out in the last few days. Remember, we saw US CPI last week, giving that positive boost to risk on sentiment because we did see that weaker reading. And that was what was really pushing higher. But of course, we know that core CPI didn't come in line with expectations, a little bit higher than expected on the month-on-month figure compared to lower than expected on the month-on-month headline figure. So there was a little bit of that contrast there that was making the equity market a little bit confused. We really didn't have that drive to push higher that we would have potentially seen if we'd seen a sellout or across the board lower than expected readings. Of course, we've come to a moment now where we're at that point where we really see that the Federal Reserve has started to fall in line a bit more with market expectations. So therefore, the reaction to the data, not as dramatic as we saw, for example, in November and December. So that is what we had at the end of last week. We still had that positive sentiment coming in, but a little bit of a pause for breath on Friday. Hitting some levels of resistance. Now, yesterday on Wednesday, we saw the PPI data for December. That came in below expectations, so that cements even further the no further need from the Federal Reserve to keep increasing interest rates, at least not at the pace they've been doing. Markets now fully pricing in 25 basis points at their meeting on February 1st compared to 50 that we saw in December. So that is the data that we saw, the lower PPI, but of course, with that, we also saw lower retail sales and lower industrial production. Now, those two data points did spook the market a little bit because it's all well and good to see a bad data to cool down the Federal Reserve's hawkish tone. But at the same time, this bad data is good data has started to kind of wear out because at the end of the day, bad data does still give an insight into the economy, and that means that the economy is slowing. And we've now got to the point where I think markets are questioning themselves whether the interest rate hikes that we've seen so far throughout 2022 have already caused too much damage to the economy. Are we already in a recession? Is the data going to get worse from here on out? So all of that, of course, being taken into account after that data yesterday. We've seen a strong pullback in the main US indices that we'll see in the chart in just a second. So that is the momentum we have, the reasoning at the moment. Bad data is good data has started to wear out. We're not really seeing that like that anymore. Yes, we want inflation to come down and we want the jobs market to soften a little bit just to justify the Federal Reserve's pivot that everyone is hoping and expecting for. But at the same time, we don't want it to show too much of a detriment to the US economy, because that means, are we not going to be able to achieve a soft landing? Are we going to see a deep recession in 2023? Of course, we've seen bets of that coming off throughout the first few weeks of the new year. A lot of banks now predicting a less severe recession than was expected last quarter. But nonetheless, this data is suggesting that the economy is cooling. And of course, that has spooked investors a little bit. So that is generally the sentiment we have this morning in the market. In the S&P, we have all sectors lower yesterday. But the biggest decline we saw in consumer staples and utilities. That, of course, speaking a little bit to that fear that consumers have started to feel the pinch already. And we've seen those interest rate hikes really soften consumer spending. And something else to take into account, of course, is we've seen Microsoft announce layoffs. I think they're laying off about 10,000 employees. And that just speaks again to this worsening economic environment. We've seen it across the tech sector throughout last year. And it really speaks as a leading indicator of what may happen in the earnings sector. Remember, we have Netflix reporting this evening. And then we have some big tech names as well reporting next week. So expectations are already set pretty low, but of course, this cements that negative feeling about the jobs market and what this may mean for employment in 2023. So that is generally the theme we have this morning. Let's quickly take a look at some key areas of resistance and support before getting into the chart. So on the top side, we have, first of all, the 200-day simple moving average at 39.56. Following that, we have the descending trend line from the 2022 highs at 39.83. And then we go into the 2023 highs. So the highs so far this year at 40.16. On the downside, 100-day simple moving average at 38.65, followed by a key area of confluence around the psychological 3,800 level. And then the low in December last year at 37.63. Okay, so here we have it, the S&P 500 chart on the TradingView platform via Capital.com. As you can see, we started to see that reversal, but really that strong sell-off coming in yesterday, down about 1.5% to end the day, and really finding that resistance along the descending trend line from 2022. I've marked that as one of the key areas to watch out for in terms of topside resistance. It came into effect first here at the beginning of last year, and then throughout the years, you can see we haven't actually managed to get a proper close above it. And that's been the one key area that has been really cementing that sell-off, that bearish momentum once we've seen a rally start to fizzle out. So as I said, we started off the year pretty good, finding that strong momentum. Of course, that risk on sentiment from China really spilling into the market. And of course, the feeling that the Federal Reserve is now coming towards the end of its hiking schedule, really helping the equity market outperform. But as I said, that data yesterday actually showing that, yes, we are in a situation that allows the Federal Reserve to be less aggressive. It also means that the economy is suffering, and that is something that, of course, no one wants to see. At least not if it gets out of hand. So that spooked investors, and really finding that resistance on that descending trend line. We did manage to break above it in the last 3 sessions, but not really closing anywhere above that area. So really that resistance pretty much in force here. We've actually also broken down below the 200-day simple moving average. So of course that bearish push now really consolidated. And I think now the key area to test going forward is whether we're going to break below this confluence of moving averages here, especially that 100-day moving average there at 38.65. Again, that was another key area of support going further. So to the downside, so support there at 38.65. If we break below this area, then that is definitely cementing that bearish reversal even further. We would have cleared all 4 key moving averages, and then we'd head back towards that area of consolidation just above that 3,800 area. And of course, we've seen that consolidation here at the end of December. We found some good support along it, and we managed to break higher. So the key will be, once we get to this area, whether we'll manage to find that momentum to break higher again. Of course, if we do that, the descending trend line will come nearer and nearer as we move along in time. So therefore, it means that the space that we have between that sideways consolidation and the upside resistance will shorten, and therefore increase the volatility and potentially see a higher breakout that could maybe mean that we finally get to see a break above that descending trend line. Of course, a lot of that is going to be based and focused on what happens on February 1st. We're now under 2 weeks away of that happening. So we may see that bearish sentiment build a little bit towards that meeting, but I don't think we're going to see any material breakouts up until then. I think markets are going to be very cautious, very wary of the data, of comments that we have from central bank members. But of course, it's all going to be about what we see on that Wednesday. Are we going to see 25 basis points as markets are now expecting? And what is the comment from Powell and his team? Did they come to that as a unanimous agreement? Do we still have hawkish dissidents that want higher interest rates? We've seen some comments recently. They are a bit either side of the spectrum, but not really controversing each other. So there's valid points to support higher interest rates. There's valid points to stop interest rates altogether. So I'm assuming we're going to see somewhat of a split vote, but of course, how that comes in line, that's going to be really what cements the momentum going forward. But as I said, it looks like the bearish momentum is building. I wouldn't be surprised if we head back towards 3,800, find a little bit of support along this line, and then come and meet that descending trend line once again if we do see that positive momentum build a little bit heading into the meeting or after the meeting on those comments from Powell and his team. Let's quickly take a look at the Nasdaq as well. US 100, again, the Capital.com via trading view. Again, similar momentum, that descending trend line really coming into force as well. It's been underperforming a little bit to the S&P. To the S&P. Remember, the Nasdaq was the worst performing major US equity index throughout 2022, but it did outperform in 2021, that post-COVID recovery. So a little bit of balancing out there. We know the tech sector is in a little bit of trouble. As I said, we've seen those layoffs from Microsoft. That follows high profile layoffs that we've seen from the likes of Meta as well throughout the last quarter of the year. So sentiment on the tech sector, a little bit damaged at the moment. As I said, it is earnings season. We're going to start off with Netflix this afternoon, and then we'll also have a key reporting tech industries next week. So watch out for that. That may cement a little bit of bullish momentum because the expectations are pretty low. But again, I expect the descending trend line to be really prominent here. The 200-day moving average, as you can see, still a way away. We haven't actually managed to break close to it since March last year. So the momentum here is weaker than in the S&P, and the path of least resistance does seem to be lower for the Nasdaq. Let's quickly pull up the Dow Jones, so the US 30, again on the Capital.com platform. We've had a little bit different momentum here. Actually, we haven't seen that strength in the descending trend line. As you can see, the highs from 2022 being broken roughly around November last year. We actually managed to break higher above the key area in August, which we haven't seen in the other key major US equity indices. So the momentum here pretty good, but as you can see, the sell-off has intensified even further. We've had further room to fall here in the Dow Jones, and of course you can see coming to a little bit of confluence here just around 33,073. We may see again a little bit of sideways consolidation, but I think we have some room to go before we hit that 200-day moving average here, as you can see. So we may find support along this area. We do have the 100-day tempting to cross above the 200. That would be a golden cross. That would be a good situation for buyers there. But one thing to note is that we've been attempting to break higher on the RSI, as you can see. We didn't manage to break above the highs in November, so of course that was weakening that bullish momentum a little bit. And if we look, for example, at the likes of the S&P 500, we did actually see a break above the December high on the RSI, but we didn't manage to do that on the price. The same thing with the Nasdaq. And I said this in last week's week ahead, that a lot of that momentum was going to be determined by that RSI and that price divergence. Because we had the divergence, the RSI broke higher whilst the price didn't. We started to see that momentum fizzle out. And that was one of the key things that I signaled last week on Friday. and that has happened. We've seen that divergence between the RSI and the price really take over that bearish sentiment, of course, as well as that descending trend line and that change in momentum. That is it for today's analysis on the major US equity indices. Thank you for watching, and don't forget to subscribe to our channel.